Hello everyone, this is Blane Markham, the Chief Trading Strategist here at Markham Trading, coming to you with my weekly market update, breaking down for you exactly what I'm seeing across the market. So let's go ahead and hop right into the charts. Of course, here I have a chart of the S&P 500 pulled up. And so this week, we're continuing to still get much of the same, unfortunately, here at the overall headline index level. We're continuing to still see this very strong series of lower lows and lower highs developing in the market. Still seeing the S&P 500, along with the other U.S. major indexes, continuing to run into very significant overhead resistance, which is keeping the pressure on stocks. Now, since the last time I was able to put together a video update for you, of course, we did have really a strong move down towards the end of last week. Of course, on Thursday and Friday, we had the triple witching, really high volume, as you can see that shown right there. So really had a bit of a short-term washout there on Friday. And with those two negative days to close out last week, that actually was very significant because we saw finally the S&P 500 index crack through that very key level of support we've been talking about for quite some time. It's our green line right here. It's our 200-day moving average. We saw it trade through that level on Thursday of last week. It closed below it. And ever since then, we haven't been able to recapture that level. You see it continue to trade down, through the really kind of washout and the short-term selling that we got on Friday's session. But now, as of market close on Wednesday here this week, we've now had 5 consecutive trading sessions where the S&P has now closed below that 200-day moving average, confirming that move to the downside. Now, while the sharp selling from last week did in the short term land the S&P 500 in short-term oversold territory, you can see that as it closed below our lower counter channel here, and also to our 5-day RSI was well below the level of 30, way deep into oversold territory. So the setup coming into this week is that we were due for a short oversold bounce, and that's exactly what we got on Monday. The market did end up higher on the day in Monday's trading, but it was at the end a pretty uninspiring trading session as we began to rally through the trading day on Monday, but ultimately ended up closing just near the lows of the day, signaling there was not enough risk appetite or buyer demand to continue to buy up the market at those elevated price levels and trying to reclaim the 200-day moving average. Now, despite taking out the 200-day moving average, the index is still holding up over a key support level dating back to those lows from November, call it just about 65.40. So you can see this low here. We are kind of still grappling with that level here at the headline index. And so at least here for the short term, we are still holding that level. That support level has not been taken out and confirmed as of this point. But, given the very strong series of lower lows and lower highs that we're continuing to run into with this market, I would not be surprised by the end of this week if we do end up ultimately seeing that support level taken out by the market and confirmed with further moves to the downside. Just looking at the action from today's trading here on Wednesday, you can see, intraday we rallied up to our 200-day moving average, and that's ultimately where we actually end up finding resistance in today's trading. You can see traded almost to the penny right up to that 200-day moving average. That's where the rally failed. We traded down, actually ended up closing lower than where the market opened today. So we could be looking at a new key resistance level to the upside now, actually being that 200-day moving average now that we've closed below it for 5 consecutive sessions. Now, of course, these markets, they're being driven by headlines right now. We've gotten the Fed meeting out of the way. We don't have significant earnings on deck up for at least another couple of weeks. We don't have a real major economic data report coming up that can be a catalyst for this market either. So it's solely trading off of headlines and largely ones that are related to the war in Iran and the Middle East, related to the Strait of Hormuz, the flow of energy out of the Middle East. These are the things that are currently moving the markets right now. And there's a lot of noise related to these topics coming out right now. You've probably seen it, but 1 minute we'll get one headline that says something, and then shortly thereafter, several hours later, we'll get something that says something entirely different that almost completely contradicts it. So it's a market that's trading off of headlines. It's very volatile, and it's primed for these whipsaw type days of trading that we've seen much of here in the past couple days. So until we can get some type of definitive resolution in the Middle East related to the war in Iran and alleviate some of the pressure coming from the energy markets, I fully anticipate that we're going to still remain in this series of lower lows and lower highs and very volatile whipsaw-y type trading that we've seen here in the past couple sessions. But with that said, that's the overlook here just at the overall headline index level. I want to go ahead and show you next what it's looking like under the surface in some of the market internals here, specifically relating to the S&P 500. So our next chart here, what this is actually charting out is the percentage of S&P 500 stocks that are currently trading above their 50-day moving average, of course, going to be expressed as a percentage shown over here on the y-axis. And so the way you can think about this is simply illustrating the percentage of S&P stocks that are currently in a short to intermediate term uptrend. Now, you can see when the market was near all-time highs just several months ago, earlier this year, you can see, we had very broad participation. We had, between 70, 75% of the overall amount of stocks in the index participating to the upside, trading above their 50-day moving average. Again, you can see that was the case for much of last year too. We're in a very strong bull market. But here, just in the past couple of weeks, really since the start of March, you can see this has fallen off precipitously. where we were trading in February was still about 65, 67% or so of S&P 500 stocks participating to the upside. That has collapsed now. Actually, last week it fell all the way down to 20%, just 1/5 of S&P 500 stocks still trading above their 50-day moving average. You can see we've recovered modestly since then. We're just about 28% of S&P 500 stocks, so just marginally over a quarter of the index is actually still in a short to intermediate term uptrend. So this really speaks to you about a lot of the trend degradation that has occurred under the surface. This is a really great internal indicator here to determine the breadth of participation across the board, and you can see it has really fallen off here in recent weeks. So what this indicates is that there are very few stocks at this point that are still participating to the upside, that are still experiencing some very bullish trading. The many stocks now are actually starting to break down and actually put together solid trends to the downside. Now, with that said, I do want to go ahead and share with you one additional chart to take a look at some of the internals here in the market. This one's actually a bit of a bright spot here for the market. So I did want to share this one positive note here to show you that not everything is completely broken down. Not everything's entirely doom and gloom yet. So what we're looking at right here, still sticking with the market internals, but looking at it from a different angle here. So what we're looking at here is still at the S&P 500, but this is the advanced decline line. So simply what this is charting out of all the S&P 500 stocks, that entire basket of stocks, whether there's more stocks increasing on a daily basis compared to the number that are declining. So when you can see this line trending up over time, that means more S&P 500 stocks are net advancing or increasing on a daily basis compared to those that are declining. Now you can see several major periods here where you can see some sharply downturned red lines here. That, of course, is indicating when there are more S&P 500 stocks falling than are advancing. So again, this is a really great breadth indicator here. It's one that we like to track very closely, and we think it's one that's really important for traders to follow to really truly understand, the full breadth of the index and of the broader markets. And so as you can see here, I've actually illustrated this with a trend line here that dates back several years. And so you can see here recently, of course, we have had some significant breakdown here in the advanced decline line. Really since the beginning of March, we've started putting in a shorter term series of lower lows and lower highs. That is absolutely true. But as you can see, I've drawn this upward sloping trend line right here that dates all the way back to the sell-off here that we had midway through 2024. So really ever since that point, you can draw this trend line from here up to this level here that dates back to the sell-off from last year related to the Liberation Day tariff tantrum sell-off. So you can see we traded down to this trend line there, rallied off of it. And then, of course, this past year, also in November, we had a bit of a sell-off in November when the markets were slumping there before ultimately recovering by year's end. You can see we traded down roughly to this trend line yet again, then rallied off of it. And you can see here now, again, even though we've broken down here in the shorter term quite sharply, we've traded down to this trend line right here. And now, at least for now, we're starting to rally off it. So, again, this is something we're watching very closely. This has been a very clear trend line of support below this advanced decline line for almost 2 years now. So it is certainly one worth watching. So if we were to see the advanced decline line crack through this trend line of support right here, that would certainly be another feather in the cap of the bears and their evidence that this market's likely to continue trending down. But I did want to show you this, that it is a bit of an encouraging sign for the longer term investor, for the bullish investor out there, that we still are holding on to the support line here for the advanced decline lines. So one positive note there for the internal market analysis. Now, I do want to go ahead and share with you next one of the trade opportunities we spotted here recently for our clients in our ETA Trade Alert service. And it's this one right here. It's for Affirm. I think we've touched on this one here recently. We're continuing to hold this position, but of course, you can see Affirm. These shares have been under pressure since peaking in September of last year. The stock has experienced several different declines over the past 6 months. You can see here through the back half of last year, through much of Q4, the stock was making a series of lower lows and lower highs. It tried to get constructive in December and through the earlier part of January. Ultimately ended up failing, making a longer term lower high here, and then began trending down quite sharply here through the earlier part of Q1, making a very decisive series of lower lows and lower highs. And here just in the past couple of weeks, the stock has broken down to new 9-month lows. Of course, you can see our trend line sell signals intact here with our 21-day EMA trading below our 63-day EMA. That's our red and our green lines I'm referencing right here. And Affirm shares have not been able to recapture either one of those EMAs. It's remained below it really ever since breaking down below it here in January earlier this year. So this stock is in a very bearish trend right now. There's a lot of stocks out there like this, but this is one in particular we focused in on. Overall, the financials have been under a lot of pressure. This stock is experiencing that same relative weakness to the downside. And it was one that was setting up for a great bearish opportunity to trade should Affirm shares continue to fall. And so that's exactly what we did. We spotted this set up just several weeks ago. Actually, it was right about here we actually sent out the alert to our ETA Trade Alert service members to go ahead and consider purchasing puts, anticipating that Affirm shares were going to continue to fall. And you can see there in very short order, that's exactly what they did. The stock continued to make that series of lower lows and lower highs. It continued to find overhead resistance here right at our middle Keltner channel in 21-day EMA. It's traded up to that level on several occasions, continued to fail there, and ultimately ended up trading lower. Just last week, the stock did break down to, again, a new 9-month closing low, and it's still continuing to make that bearish pattern of price action here just this week. Now, we have taken some partial profits on this position along the way, but we are still holding on to a portion of it. And in fact, as of market close here on Wednesday, as I'm recording this market update for you, the put option alert for Affirm that we sent out to our ETA Trade Alert service members is currently sitting on an open trade profit opportunity of 41.7%. So this has been one of our favorite opportunities here recently to leverage some of this market weakness and continue to find some income opportunities out there despite the broad poor performance from stocks. Now, I certainly hope that you're able to follow along with this trade alert that we sent out to our members for Affirm, but if you were not able to, that is totally okay, because I'm going to go and share with you now how you can ensure that you begin receiving these trade alerts just like this one here I shared with you for Affirm, possibly as soon as tomorrow. So if you want to go ahead and get signed up to make sure that you begin receiving these trade alerts from our ETA Trade Alert service, all you have to do is go ahead and call up the FFR trading team, call up Michael and the team there. They're a great team. Please feel free to ask them any questions you want to about our strategy, about our trade alert service. They're there to answer your questions. And most importantly, they can get you signed up so that you get on the list to begin receiving these trade alerts, just like the one I shared with you here today. So go ahead and give the team a call. This is really everything that I want to share for this week's weekly market update. I appreciate you tuning in. Things that we're watching here for the weeks ahead. Certainly everybody has their attention fixed on the Middle East, the war in Iran, of course, the energy markets, because that is driving the bus right now for the stock market. It's impossible to predict exactly how this war is going to end, when it's going to end, what that conclusion could look like. But the headlines surrounding that are certainly what is driving the price action in the markets right now. So we're, of course, watching it very closely. We fully understand that this is a market that is primed for whipsaws. And so we're keeping that in mind when we're spotting trade opportunities out there, when we're sending out alerts to our Trade Alert service members. We're trying to be wise managers of risk with the trade alerts that we're putting out there, understanding that this market could turn on a dime at a moment's notice simply because of a post or a headline. That is what we've seen over the past couple of weeks. So we remain to keep watching this conflict very closely, looking for any possible updates that could be relevant to equity markets. And we're certainly continuing to watch the technicals very closely, because as you saw in today's weekly market update, there's certainly a lot of things that need to be paid attention to very closely. There's some key technical signals on the charts, support levels, resistance levels, things that need to be watched because they can have a major bearing on where stocks go trading next. So with that, thank you again so much for tuning in. I really appreciate you watching this week's weekly market update. Love to see you go ahead and join our ETA Trade Alert service program. So go ahead and reach out to the FFR team to go ahead so they can get you set up with that today. But again, thanks for tuning in. I hope you have a great rest of your week and weekend, and I'll see you back here next week with next week's weekly market update. Until then, take care, everybody.